All right, investors, ladies and gentlemen, Finom Group members. My name is Seth Golden. I'm joined this week by the illustrious Brad Carter, and this is Finom Group's weekly State of the Market. Thank you for tuning in once again, and to what has become a rather trend-worthy market so far through the month of January. Brad, I thought I'd kick things off this week. I mean, based on where we were last year, based on where the markets basically ended the year, what are your thoughts on the relative strength that we're seeing in markets this year so far?
You know, it seems every year January wants to bring in some kind of a reset. And more often than not, the reset's kind of a little bit in the other direction and sometimes a lot in the other direction because we've been doing well. And this year, it was just like, I don't know, the investment community just wanted stuff to start normalizing. And like I was looking at the price action today, and it almost looks like a melt up. You know, it's like it's not irrational exuberance or anything like that. It's just, Microsoft comes in and if you look at that on the whole, you go, it's not that bad. And then Tesla comes in and, hey, it's not as bad as we thought it might be. And I think that's kind of what's going on. It's a good time to remember, though, that a year like this is very likely to have a lot of fits and starts. That we're gonna see a bit of a roller coaster ride here. But be honest with you, I've been doing this long enough, especially working with you, that I kind of relish that.
Yeah.
Because it presents so many new opportunities. It's a real good time to be careful about, chasing and getting over your skis and being over invested. And, I started out the year with, looking back, almost too much cash, given how things started. But I'm still sitting around 40% cash because I just know, there's those good companies that we really, really like are going to have their little troughs, and that's going to give us an opportunity. So
Yeah.
I'm looking forward to the year. I think I think at the very least, as I said in another podcast, that this is at least going to be a pretty good year, because for those of us that have learned the discipline of hanging on to cash and buying the dips and so forth, you can have nearly a sideways year and come out pretty good.
Yeah. Managing cash wisely, scalps throughout the year, waiting for those more, those 5% drops usually happen 3 times a year on average. And the average correction since 1980 has been 14% on any given year. So yeah, I mean, I like what's taking place here in January. Kind of a reset of the bearish price action, a reset of the bearish sentiment. There's folks that don't believe, what they're seeing, and are, suggesting that this is just another bear market rally. But I'm seeing character change. I've seen it since the first week of January here. And as they say, let price lead the way. And I'm looking for those dips as well. I'm almost kind of thinking that this year could be a mirror of what we saw in 2019. People look back at 2019, which, the S&P delivered a 31% total return, but it wasn't easy. Remember, that was when we were still in the China trade war and dealing with, and then I think it was in May, the White House administration threatened a trade war with Mexico, and the market fell 8%. And people were realizing that that's actually a bigger trade war than it would have been with China, because of how many times goods, are crossing the border for full assembly. Like, whatever widget it is, is manufactured in China, in Mexico, comes back to the US for assembly, goes back to Mexico for one reason or another, just the final parts and what have you, and then crosses the border another time, well, that would have hit tariffs every single time.
Right.
And so the market dropped. I think it had three separate 5% drops intra-year, and the biggest one was 8%. So, the 31% looks awesome in hindsight, but you had to endure some pretty volatile times. And to your point, I think that's kind of what we're going to see here this year, assuming the Fed doesn't screw things up, which is always something we got to keep in mind.
Oftentimes the rhetoric is worse than the reality.
Yeah,
you can't you just can't have a trade war with Mexico.
And they realize when they realized it.
Yeah, smart people in the business community know we can't have that. That's just too much of our economy,
Right.
But I think despite the fact that smart people see that as rhetoric, they still react to it. And that's what you get. Everybody's thinking, well, let's just sell something now because we're going to buy it cheaper in August or something. And didn't the chart bottom out kind of late summer that year? I'm trying to remember.
No, May was
it May
for that particular year. It was right around. There was another threat in October because there was a deadline with there was a deadline that White House administration had levered against China that they would add an additional tariff come this October deadline. So we had another late year 5%, 6% drop. And then the administration decided not to go through with it, and the market rallied into the end of the year.
I just remember at some point when things really bottomed that I just didn't buy into it. The economic conditions were too good and all that stuff. So I just, I started overweighting for me, I should say, UVXY and that kind of thing, and finished out what was my best year ever, actually. But
yeah, that was a pretty strong year. All right, so let's get into the meat and potatoes of this week's State of the Market. The yield curve is the most inverted in decades, yet many parts of the market are making new 52-week highs. The ISM manufacturing index is below 50, yet materials are some of the strongest sectors in the market. Mortgage rates spiked, yet home builders are doing well. What's the lesson here? Always follow price. This is from my friend Brian of Alpha Charts. This was something that he had spoken about earlier this week, and I thought it was just, you wouldn't expect materials industrials to be doing this well when you have an ISM manufacturing index below 50. And for all of the recessionary noise around the housing industry, why are home builder stocks doing so well? Keeping in mind that last year they had their bear market, and they've been just, from that trough, I would say it was probably around June or July is when the housing ETF bottomed. We can see for sure here. Hold on. That would be the XHB. Do the 1-year chart here. Yeah, look at that. June of last year is when the home builders ETF bottomed. It retested in October, but it didn't make a lower low. And here it's trying to get back to the peak from August. So this has been in an uptrend ever since making that low here in June of last year. And the data that we got on housing today, right? New home sales, who would have thunk it? New home sales grew month to month. So, the markets are forward discounting mechanism, and they're seeing the recovery in the housing market well in advance of the actual recovery in the housing market.
Yes, that reminds me, we touched on this a couple of months ago with respect to interest rates. As of right now, interest rates are historically pretty good, and the consumer has lots of cash, and looks to me like they're just going out and saying, okay, we can handle that anyway.
Yeah,
at least for now.
All the fuss about last week's retail sales being down month to month, 1.1%. Yep. I don't know why they deliver the report that way, because on a year-over-year basis, we were up 6%.
Right.
But everybody focuses on the headline month to month because they're trying to catch the worst of a trend that might be developing.
Well, and
it wouldn't
they're
surprise
trying.
me. I'm
Go
sorry.
ahead.
Yeah,
I was just
say
going
it
to say
wouldn't
they're trying to
surprise
get
me.
people to tune into it. And you got to remember that. You
Yeah,
know, CNBC almost every day has
yeah,
some of the most ridiculous headlines, and then you read the whole story, and the story doesn't even match the headline.
yeah. I know it's crazy. This chart right here just speaks to, okay, we are in a new year, and the trend seems to, or the tide seems to be shifting in favor of the bulls. You know, but all we did last year was preach: stay in the market, take your drawdown like a big boy and girl, manage cash wisely. You lost time, but if you didn't hit the sell button, you didn't lose money. You just lost some time.
Yeah.
And you know, this is how the market works. The stock market is the opposite of a casino. The longer you play, the higher the odds are that you win. If you only play for a day in the market, the odds are 50-50 that you're going to make a profit. 5 days, closer to 60%. 10 days, closer to 60%. Go out a month. If you stay in the market a month, you got a 62% chance of winning. You stay in the market a year, you have a 75% probability of making a profit. 5 years, almost 90%. Every 20 years, as long as you stick with the market, the odds are you are going to make a profit. It is not a casino. The longer you stay in the casino, the more likely they are going to take your money from you. So market is not a casino. Stick with the market. Take your drawdowns like big boys and girls. And the reason why I brought this up is because we know how hard it is. Last week we talked about fund managers just can't beat the market. They're trying to be stock pickers and they do a poor job of it. But here's the worst thing that I found out. This is awesome. King's College of London, they did a research, they did this research, and here I put the link to the research note from King's College, where the authors surveyed active fund managers about how they were responding to the shift in favor from active investing to passive investing over the past decade or two. But they also asked questions about how these managers invested their own money. Not the fund's money, not their clients' money, but their own money. They asked the active managers how they invested their own money. And here's what they said. The active managers invest their own capital passively. Many of the comments from active managers were eye-opening, but none more than, all my money is in index funds. All my money is in index funds. They even said, they would even say in this research report, they wouldn't invest in their own fund. Their money, they invest in index funds. But the fund that they're managing for clients, they wouldn't even invest in it. I mean, it's just crazy. It's just crazy. As Warren Buffett, one of the greatest active investors of all time, noted long ago, a low-cost index fund is the most sensible equity investment for the great majority of investors. Everybody's trying to be the greatest stock picker of all time. And don't get me wrong, if you're going to outperform the market, you probably need to have a few stocks that are going to outperform the market. But if the market's returning 9% a year over the last 20 years, that's a lot better than anybody's getting in a savings account. Even with higher yields today, it's a lot better than you're going to get in any, money market CD. So index ETFs are going to get it done for the vast majority of investors. But for some reason, we have this ego where we can do it. We can beat the market, and people fall into that trap. So, well, we came into this year, net non-commercial futures positions, these are your hedge fund managers. And they were very, very short. And I remember saying, that this is usually how bull markets start, when everybody's leaning, to
Yep.
one side of the boat. And lo and behold, this is how we came into the year. And we know that a lot of this rally is short covering, especially the tech sector. Significant portion of the tech sector is short covering. I mean, that's why you have the material outperformance in growth stocks, even in unprofitable tech. But this was in one of our, notes in the past for our weekly research reports, that, this is part of what you need to fuel a new bull market. And here we are. This is from All Star Charts, Willie Delwich. The investor intelligence bull bear spread is trying to get above this 20% line, which usually kicks into, it's usually you're in a bullish trend when you get above this 20% level. We're not there yet. But imagine if we do get more investors on board with more bullish sentiment, that usually will be that second wind at the back of this market's, the green shoots of this newly forming bullish trend. And the same thing, this is from Ned Davis Research, risk on versus risk off diffusion indices. They've gone positive. You see them hooked up, from very bearish levels. All of these different diffusion sentiment indices have all hooked up into positive territory. So investors are getting a little bit more upbeat, but we're not quite over this threshold for the bull bear spread in the investor intelligence report, which is newsletter writers, which are often bearish. They want people to buy their newsletter, so they sound cautious and they're skeptical about everything, and that leads their readers to think, whoa, this guy's really thinking, deeply about, so I'm going to buy his newsletter. Doesn't work that way, folks. This was also from allstarcharts.com. Declining 200-day average tends to be a headwind for the S&P 500, which is true. You've heard the saying that nothing good happens underneath the 200-day moving average. What I often look at things, the glass is half full, and I say, if the market's below the 200-day moving average, I'm getting cheap. I'm getting cheap prices. I'm getting value. I think that's a good thing. It just depends on how you look at it. Anyways, the S&P 500 has rallied off of its October and the December lows, but the 200-day moving average is still sloping downward. Over the past 2 decades, all of the net gains for the S&P 500 have come when the 200-day average has been rising or sloping upward. It basically means you're not making new all-time highs in the S&P without the 200-day moving average curled up and trending higher. So it's something to be aware of. It doesn't mean that the market can't start a new bull market, before the 200-day moving average is going higher. It just means that it's unlikely that we're going to be at 52-week highs without it moving higher. So again, just something to be aware of. And this is where I was talking about. This is the equal weighted tech sector ETF, ticker symbol RYT, which has had a really nice rally here in the new year. This chart comes from Fundstrat. The equal weighted tech showing particular strength this year, and it's had a golden cross. That's what they're highlighting here. And a golden cross is basically when the 50-day moving average crosses above the 200-day moving average. And that's historically bullish. The 12-month gains after a golden cross are 17%. The median gain is 21%. And the win rate or positivity rate over that time frame is nearly 90%. And that just happened, folks, for the equal weighted technology sector. Yesterday everybody kind of panicked after Microsoft, right? Microsoft delivered results, and initially the stock went higher. I know we were watching in after hours. It was up to, I think, $253. It was an $11 after hours gain. But then came guidance on the conference call. About 6 o'clock, the stock started tanking. And it wound up, I think, down $5 in the after hours when the after hour session closed. And that sent futures down. And the next morning, futures were down big. And this is how we started the day from the opening bell. Here's 10 o'clock a.m. yesterday. There's 10:30. And at Finom Group, we try to educate our members on market operations and what the different times of the day mean, to the market. And, as you, the investor or trader, especially if you're actively trading. And I've been doing this for 22 years, so I understand what the different times of market hours mean. And so from 9:30 to 10:30, that's known as order flow. Most people will see stocks whipsaw in price up and down, and there's not really true to price discovery that can be found during that first hour of trading, which is again known as order flow. And what's happening there is the market makers, which have taken orders from the after hours the previous night and the pre-market of that trading day. The market opens, they're trying to match those orders up. The buys and the sells, they're matching them up. So you get these really big swings in price for individual stocks during that first hour. Now, most institutions and most savvy traders know that that's what the first hour is, and they stay away. They don't trade the first hour. Some of you may have heard that before, but this is the rationale. And once the first hour is over with, the majority of market maker operations are completed, and that's where the active hands start to trade the market. And wouldn't you know it, 10:30 was the bottom yesterday. So when the active hands came in, it was nothing but upside yesterday thereafter. And what we talked about in the trading room that day, yesterday, when we had futures down so much is, look, we're starting to see a character change in the market. Last year, we'd have a nice couple of up days, and all it took was one day to take back all the gains. But this year, whenever we have a down day or a down couple days, all it's taking is one day to recoup what was lost. That is a very dynamic change from what we had last year. And so I was expressing in the trading room with our Finom Group members what I wanted to see from that downdraft, that morning, yesterday morning, was the dip buyers. I want to see if they're going to still buy the dip here. Because if they do, that means that this is solid. Like, we do have a true character change in the market. The buy the dip impulse is much stronger than last year. Did I get what I wanted? Well, obviously I did. We saw the dip buyers come in. So that's 9:30 to 10:30. And then 10:30, you have the active hands. At 11:30, you have the European close. Also at 11:30 to 1:30, Wall Street goes to lunch. And yes, folks, it's an extended lunch for the Wall Street folks. You lose a lot of liquidity during, that time frame as well. 2:30 to 3 o'clock is what we call the lean period. Usually the market starts to lean in one direction or another from 2:30 to 3 o'clock. And then everybody's heard of the power hour, which is 3 o'clock to close. And power hour, about 67% of the time, will adhere to the lean period, whichever way we were leaning. Usually it just compounds that move. So I just thought this would be useful for most market participants who are actively trading to know what's going on and why we tend to have lulls, in this afternoon period because of lunch, and there's the order flow dries up, you lose liquidity. But then later in the day, the lean period, and this was 2:30, folks, not making this up, draw your arrow. 2:30, we started leaning, we pretty much finished where we were. So hopefully that was useful, a little bit of intermarket operations education, if you will. All right, here's another chart that we've been refreshing in our weekly research reports. It's the NASDAQ high-low index ratio. And, once we go cycle from these deep levels to 0.29, which we did, and I want to confirm it. So when we go, from these levels 100-day moving average crosses above 0.29, but there's no red dot there. This is from Sentiment Trader. So I wanted to confirm that we did indeed get to the 0.29 level, because a year later, every time the market has been positive, and the returns are spectacular. And again, this is for the NASDAQ, not for the S&P 500. And here's Jay Capillo of Sentiment Trader. Like, this is his. And he said, not off to a great start, but for what it's worth, this indicator just crossed over to the bullish side of the ledger using that ratio, the NASDAQ high-low. So this is what we can anticipate. We may not get the average, but the average and the median return, my gosh, 37 and almost 40%. And a year later, the win rate, 100%. 6 months later, the win rate is 100%, folks. 6 months later. So, we'll see if this year a lot of the data holds up, and something that might tell us that the quantitative data will perform to its higher probabilities this year, more so than it did last year, might be how January finishes. Folks, we're up a little more than 5. I think we're up a little more than 5% here as of today in the month of January. There's only 4 more trading days to go. So it looks like we're going to get the trifecta. I don't want to jinx it, but it looks like we're going to get the January trifecta. Typically, when you have the January trifecta, there's an 89% probability that the following 11 months of the year are going to be positive. You're going to finish the year higher than where you ended in January. But if the previous year was a bear market, and then you get the January trifecta, the market has never had a down year. That's 100% positivity rate. I like that, folks. I like that even better than if it's just a plain old January trifecta. Bear market, prior year, January trifecta, never been down. It's happened 13 times, and all 13 times the market was higher. So again, we got 4 trading days left. We're up 5% already in January. We should be okay. Keeping in mind that February 1st, thankfully, right? Because the Fed meeting is February 1st. It's not, the final day of January, thankfully. So even the Fed can't screw this up for us. Okay. What else? Everybody's making a fuss over. I've been trying to, I guess, go through the calculus of, what if we do have a recession this year? What if we have a mild recession? Soft, shallow, quick recession? Because we're still hearing the drum beats of the market's going to retest the lows. What if we don't have a recession in the economy, but we have an earnings recession? The market's going to retest the lows. You have even JP Morgan's Marco Kolanovich, right? I mean, even he's gotten bearish, saying that this can't last. This rally can't last. We're probably going to go down to, they say, at least 3,600. Morgan Stanley's Mike Wilson says 3,300 to 3,000 if it gets really bad, predicated on an earnings recession. And I go back to the fact that everybody is also saying that last year was just about a derating cycle. Last year was just the equity risk premium, right? And the market has to adjust to a lower equity risk premium. But what I think also gets missed or overlooked or not even considered is that if you don't have the recession, and even if the earnings recession is mild, like less than 10%, the market's never been down. It's never been down. It's always given you a positive return. And what I think happens is that former derating cycle no longer survives because you can't keep yields up. You can't. We're 100 basis points lower than the peak of the 10-year yield. You can't keep it up there. So the market basically says we corrected for time. We corrected for time, but now we have to correct the correction because nothing bad happened. So even if we get the recession this year, the market would have already accounted for it last year. It's no longer a derating cycle because the equity risk premium is higher. It corrected for that recession. Recession in earnings or recession in the economy, it did that last year. It changes. The investor doesn't care anymore about derating because the 10-year yield is no longer going up. It no longer has to worry about the equity risk premium. It's taking advantage. So you have a transposition of the rationale for why the bear market occurred last year. And if that's the case, we don't have to retest the lows. We don't have to make lower lows, recession or not. It's a thesis, right? That's all it is. It's a thesis. We'll find out, if that actually comes to pass, but I'm leaning more in that direction. Especially because everybody sees it coming. Everybody sees it coming, folks. Everybody sees this recession. Everybody sees the bad earnings guidance. And yet they're still willing to to throw this signal. It makes no sense. Everybody has this data. It's in the Almanac Trader's Guide. And yet institutions are still buying the market, knowing the Fed is still going to be hiking, knowing that, if you go by the New York Fed's recession model, which is the recession model, a recession is essentially inevitable. And yet everybody's buying the market and basically going to throw off this signal. That just doesn't make sense unless there is validity to rationalizing a transposition of why we had the bear market last year and we don't have to do it this year. What do you think about all that? I know it's a lot to consider, but I'd like to hear your thoughts.
I think you're going to say mine are about like yours, but I remember last year, about the middle of the year somewhere, we're in a recession. And then later they said, no, it's going to be in the fourth quarter. Yeah. No, it's going to be in the first quarter.
Yeah.
Then it's going to be the latter half of the year. And now I'm starting to hear 2024.
Right.
We've always got a recession on the horizon.
Right. And also the reason why I put these charts up here is because, and why I'm, this thesis I'm throwing this thesis about transpositioning the rationale for last year's bear market is because, people say, no, that's derating. That's a derating cycle because the Fed is raising rates. The market goes up during rate hike cycles. These are all the rate hike cycles since 1962. Here's the S&P 500 change. 78% of the time, the market is higher during a rate hiking cycle. So don't tell me that the market was down last year because the Fed was raising rates. You could make the argument they were raising rates at the fastest and people got scared. But this gives credence also to what I believe is you just get this transpositioning of rationale around why we had the bear market last year, basically disavowing the ability to cycle lower again in 2023. All right, with that, we do have the leading economic index, which came out this week, 10 months in a row, negative territory. We've never done 10 months in a row of the leading economic index being down 10 months in a row without being in a recession. Every time we've been down 10 months in a row, we've been in a recession. So, it does get hard to disavow, that we are not in a recession at this point. I get the arguments because this has never happened before. But we've been saying that since 2022. You know, there are so many things that have never happened before. The two things in the LEI that are not flashing red are employment. And one of the things that is in the LEI is the S&P 500. And so when we get the January LEI, it's probably going to improve because the S&P 500 is a component in the leading economic index. So we'll see. Now, here's also something that most people have heard this before. We've never gone above 5% in the CPI and then cycled, below 5% without a recession. I mean, I think everybody's heard that, but not. The gray bars are the recessions, and the pink bars are the recessions as well. I shaded the pink bars because, these are the zones where we had the recession and you had CPI tick above 5%. Here's the 5% horizontal red line here. Now, there's only one time in history, actually, one time in history that we've gone from 2%, right? That's the Fed's target for inflation, 2%. Only one time in the post-World War II era have we gone from 2% to above 5% CPI, then back down to 2% without a recession. And that was 1950 to 1953. 1950, we started below, 2% even. We cycled above 5%, got up to about 9+%, and then we cycled back below 5% without a recession. And this is people, they'll stop their clocks here. Yeah. Nowadays, when they say the market has never, or the economy has never not gone into a recession after you've had inflation above 5% and cycled down below. But if you go further back in time, obviously we have done that. And this is also why I think just the market and the economy are out of sync. I think they're just out of sync because we're just not used to this. We don't think the Fed can do it. We don't think that the inflation is going to fall, by itself, when it already has, and it's likely to continue falling, through this year. But I think we're just too far removed from this occurrence. The only difference between today and the 1950s episode, there was no bear market here. 1950, positive returns. 1951, 1952, positive returns. It wasn't until 1953 that we had negative returns and a recession, this pink line here. And that's the difference. We're out of sync with the market for the current situation, because the last time we did this, market was actually positive. That's why I say we went into a recession in 1953. If we go into a recession this year, we've already done the 1953 bear market, though. And yet we'll get this down below 5% this year, unless something crazy happens in the energy patch. So I think 1950 episode is a very good case study in what could happen this year, absent the fact that we've already had the recession bear market. They never had the recession bear market during the CPI episode. They just had a bear market recession after. And I think it was just too much deflation back then, too much deflation that sent it into a recession. Any thoughts?
Yeah. One of the things that is thrown off a lot of the usual indicators that we've come to depend on, the 10-year, the 2-year, on and on and on, is COVID caused the government to do some unprecedented things, which is threw everything off. That's why when we showed those 2 quarters of negative growth, I was going, yeah, but where did it top out at? 8% growth right before that or something? So you got to look at the whole thing over time, and the inflation worries. Yeah, I had an economist friend of mine a few years ago say, Brad, it is so bad now. We could use a year of 5% inflation for a reset,
Hmm.
because we were in that territory really since, you could argue, since 2008, I suppose.
Yeah, no wage growth. Yeah.
No wage growth, and deflation for
Mhm.
brief periods of time, and interest, and they left interest rates low for, I mean, incredibly low for a long period
Mhm.
of time, because it wasn't hurting anything.
Right.
Inflation was more than in check, and so forth. So we get this upheaval that I argue is all COVID, every
Yeah.
bit of it. Throw in the Russian war with Ukraine, but that kind of came in later. But yeah, sometimes you just have to go, okay, there's all these rules out here and all these indicators that say yes, recession, 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 but you got to step back and look at the whole thing.
Yeah. Yeah. Absolutely.
And
Wide
we have a
lens.
mild recession this year, maybe. And as investors, we just need to tailor our investments so that we're ready for something like that, or another little drawdown.
Yeah.
We could wake up one morning, be sitting at 3,600 on the S&P. It's possible, and I don't care. Just be ready for it.
Yep. All right. Our next up to bat. Oh gosh, some of the things I see on Twitter. It's like, CNBC. People just say stuff that is just absolutely less than intelligent. All right, here's Julian Brigden. The strength of the home builders has been perplexing. One explanation is the new home sales data has remained strong, but this data doesn't reflect cancellations. And KB Homes just dropped a bomb in KB Homes report. They reported on the 11th, and they said their cancellation rate was 68% compared to 13% in the prior period. When I saw this, I was like, dude, what's wrong with you? There's no such thing as cancellations. A home is not a discretionary spend. If I go to the grocery store, maybe I didn't bring enough cash on me or something. I put the Snicker bar, back on the shelf or whatnot. I put the extra box of cereal away. Like, that's discretionary. I can deal with. If I want to buy a home, that's a fixed cost. I'm buying it because I can buy it. If I cancel it, it's because I'm making a decision. I don't want to pay the current mortgage rate. These cancellations are not a bomb. These cancellations are what they call pent up demand. They're fuel for the next cycle in housing. This is KB Homes, folks. Let's look at the chart of KB Homes real quick. What is the KB? There we go. Here's KB Homes. Go year to date. Here was the 11th when they reported. Here it is today. You think investors don't realize that's just pent up demand? It's just people that are waiting for rates to come down. That's all it is. It's not a bomb, but that's what, this is the stuff that you see on Twitter. It's just nonsense. Guy has over 100,000 followers. Look, 390, people thought this was an oh my gosh thing, because he's coloring it or characterizing it this way. And you see a high number of cancellations, and you hear all the headlines about, how bad housing is right now. And people just don't realize the market's not stupid. Investors know that cancellations are just pent up demand. That's good for KB Homes in the future. How is housing doing? Look at mortgage applications. This just happened over the last 4 weeks. This is not refinance applications either, folks. The tide is shifting. Home buying demand began to recover as mortgage rates fell at their fastest pace since 2009. What have I been saying? As soon as the bond volatility starts to abate, the MOVE index is the volatility of the bond market. As soon as that starts to come down, mortgage rates are going to come down. And they've come down at their fastest pace since 2009. We've gone from 7.5% on the 30-year fixed rate mortgage to 6.14%. And all of a sudden, look at mortgage applications to purchase to purchase a home. I mean, we're
You know,
starting.
one thing worth mentioning there, Seth, is I think a lot of us have this tendency to jump to the conclusion that there's a direct correlation between the Fed rate and the mortgage rate, and it's just not true.
No, it's not a 1-for-1. Correct. It's not 1-for-1 at all. You know, the only thing that made it seem that way in this current rate hike cycle is the anxiety around, are they going to go 25, 50, 75? Are they going to go 75 again? And so the bond market was moving 10, 15 basis points a day. That's not normal, you know? So the volatility is what was causing, you know, the mortgage rates to rise to the extent that they did. But yeah, when that volatility abates, has the Fed stopped cutting? Has the Fed cut rates? Has the Fed stopped raising rates? No. And yet mortgage rates have come down, to your point. Thank you, Brad. Good stuff, sir. This is Goldman Sachs. We expect existing home sales, not new home sales, but existing home sales, to have bottomed by the end of the first quarter. Purchasing intentions have rebounded sharply in recent months as mortgage rates have come down. I want to be specific. Now, I've been of the mindset that housing would bottom by the end of the first half of the year. So June, July, and base. I think we could base through the third quarter and start to inflect upward in the fourth quarter. I'm okay being wrong if it happens sooner. Don't get me wrong. I'm happy to be wrong about good things. But I don't think it's going to be this simple. I think if we do bottom early, we'll probably have a longer basing period. Because keep in mind, the Fed doesn't want prices to all of a sudden start to ratchet up again. And the most powerful message the Fed has, the most powerful tool the Fed has, is the message. And if the Fed believes, you know, that things are starting to get to escape velocity once again in housing or in the stock market, that message is going to become overtly hawkish, as if it hasn't already. But you know, we're expecting a 25 basis point hike next week, right? That's the most dovish hike they've done since the first hike last year in March. But within hiking, they can hike hawkishly. Coming into this week, I said, I tweeted it out last Sunday, I think it was. We'll go to the tweet. If you're not following me on Twitter, folks, probably a good thing. No, I'm only kidding. This was January 20th, right? We had it was a down week, but the NASDAQ was up last week. And I said, do you smell that? It smells like the markets are going to piss off the Fed next week. Because I mean, I'm looking at breadth underneath the market. And I'm like, even though the S&P 500 was down like 0.5%, things were still moving higher. Most stocks were moving higher. And what better way to, you know, put the Fed kind of the markets don't like to make it easy for the Fed. And it just felt like the markets were going to pick a fight with the Fed this week. And lo and behold, we're up, 2+% this week? So I think if we keep, there's only one more trading day, but I think if we keep this up, the Fed is left with no choice. And this is going to possibly be a good opportunity early in the year. If the Fed hikes 25 basis points, which they are, 25 is basically guaranteed, folks. But the message is really hawkish. Like, it wouldn't surprise me if Jerome Powell harped on above 5%. If he feels that they need more time and they don't want this S&P 500 to keep going and they don't want housing yet to rebound strongly, the message is the best tool that they have to temper things down. And the markets will pay attention. The markets will take it and say, oh boy, above 5%. We're thinking a pause here in the first quarter. You know, even if they hike in March 25 basis points, that just gets them to 5%. So above 5% is yet more hikes thereafter. And the market's going to want to say to itself, we better price that in. and you might get your pullback. So
wasn't it Bullard that made the comment that just it stunned me because he said what I knew what he was thinking out loud in a way that you just shouldn't.
5
He
to
said,
7%.
He said, yeah, we want to get above 5% and then we'll be data driven.
Yeah. Yeah.
You know?
Yeah. So yeah, I think if we keep this up, and I knew it. I knew the market was going to put the Fed in this position. And you know, the market is about, it's chess, folks. It's not checkers. It's chess. You got to think ahead. And so that's what I've kind of been preparing us for. You know, Finom group members for is preparing us for possibly that next move on the chessboard next week at the FOMC meeting. But it's going to be an opportunity. The market wants to go up, folks. Again, we're going to get this January trifecta. It's geared. The fund flows are there. The fund flows are there, folks. So new single-family homes came out today. New home sales came out today. They rose 2.4%. Economists expected it to decline 4.4%. Right? We're listening to economists predict a recession in the first quarter, second quarter, by the end of the year. And this is how much they're off when it comes to new home sales already. We've all been hearing about layoffs, right? I mean, you got Microsoft, Amazon, Google, even Apple to a lesser extent, Meta Platforms, Spotify this week. So many companies announcing these layoffs. It's mostly in tech. It's mostly Silicon Valley. But just keep in mind, folks, that's what we're talking about. You got to put it into context. And this is the chart of where we're at with layoffs.
We are still in a job shortage. We're in a
Right.
job shortage.
We
It
just
shows
got
up as-
jobless claims today, and they kept going down.
Yeah, you look at small business everywhere,
Mm-hmm.
including what's going on in my little county here, and they have to import workers every time they have a project of some kind. It's just the way it is.
Good notes here from what do tech layoffs say about the economy from Bank of America? And I'll just surmise it. Bank of America layoffs in tech are easily being outweighed by labor hoarding in other industries. A correction after basically, you know, tech has overhired. The macro signal here is small, meaning this just doesn't have the ability to scale. These companies are not small businesses. And to your point, Brett, small job openings by business size. So the smaller businesses with under 250 employees, that's where the job openings are, folks. That's where the importance is. It's small businesses. They're the ones that do the hiring. They are doing hiring across the nation. Everybody's talking, oh, the consumer's in bad shape. Look at the credit card debt. Look at, delinquencies are starting to take up. This is where we are today, January 2023. Here's the 90-day delinquency rate, 0.45%. Here's the 60 to 89 day delinquency rate, 0.23%. How bad was it during the great financial crisis period? Look at that, folks. We are nowhere near these numbers. These, even 2007, 1.9%. It's 4 times greater than where we are today. The households know what they're doing. They're not overextending themselves. David Solomon, this is the CEO of Goldman Sachs. He always gives a statement about the quarter and about the economy and the consumer during their Q4 earnings release. There aren't many signs of widespread distress. Balance sheets and company fundamentals are relatively healthy, but it's clear that the outlook for 2023 remains uncertain. Balance sheet and company fundamentals are relatively healthy. No, there aren't many signs of widespread distress. I'll take him at his word. And, this is a chart that I've been, highlighting for many years here at Finom Group. This is basically the consumer's balance sheet. In past economic cycles, here's the boom bust cycle of the dot-com period. where consumers leveraged higher and higher. And then they deleveraged because of the recession. But then came, 2003 to 2009. All they did was leverage higher and higher and higher. No money doc loans, houses for free, reverse amortization loans, no job verification loans, and people were just, leveraging to the gills. But what happened after that, and due to the great financial crisis, is probably the greatest deleveraging in a generation, in a century. In other words, this was so bad, it created a dynamic behavioral shift in the household budgeting. We now know, the average household no longer borrows that which they can't pay on a monthly basis. They get the credit card bill, they pay it down. This was the great deleveraging process, and this is the greatest balance sheet in history, going all the way back to the 1960s. So keep that in mind, folks, when we talk about, look, if we're going to have a recession, it's more than likely going to be very shallow and very brief, because the balance sheet is just too strong. This here is average deposits. This is the average deposit held by the bottom half of American households, not the rich. This is just the bottom half of American households since the pandemic. Are they drawing down on their savings? Yes, but they still are in so much better shape than the pre-pandemic period. Mm-hmm. But this also shows you they were doing a good job ever since the financial crisis when it comes to their, monthly deposits. It kept increasing before COVID, but with those government transfer checks, you had this big gap. Let's just hope gaps don't get filled in this case, right? And that's all we have for this week, folks. So, Brad, you got any parting words so far as, what do you think so far as next week in the Fed? What are you anticipating possibly?
Everything. We'll just circle that date,
Yeah.
They've really softened up quite a bit on picking on us here lately.
I know, but I just feel like the market's giving them all that they, need, in the way of ammunition to start picking on us again.
So if they want to pound us again, okay, so be it. I'll go back and buy those volatile stocks that
100%.
I
think the market's made up its mind. I think the market has said, look, and I also want to go on the record as saying we could have one of those blips in CPI that are unfavorable, in the first quarter, until we actually get the shelter component, to make its way into the CPI data. We could get a blip. That could also be an excuse that, sides with the Fed to keep hiking and the market to maybe, trade down and then sideways. But based on this January trifecta and what we're seeing here in the new year, I mean, the breath thrust that we've had, the BAM breath thrust, the Whaley breath thrust, I think fund flows have made up their mind. It's year 3 of a presidential cycle. That is historically always been positive since the 1930s. I think any dip is going to be a huge buying opportunity, just like I said in our weekly research report, and just like we did yesterday when the markets capped down. I mean, you guys were buying Boeing. You were buying everything. Boeing also reported and gapped down, and we were buying Boeing. We were buying PayPal. We were buying the Qs. There are opportunities, and you have to have the conviction. Hopefully, our weekly State of the Markets and our weekly research report are giving investors all the tools, all the data, all the insights that they need to make convicted choices about how to allocate capital.
Dare I make a small cap stock pick?
Oh, go ahead. I'd love to hear it.
I've been in this one before, and people paying attention on Telegram noticed that I bought into it a couple of days ago again. Papa John's.
Oh, yeah. PZZA.
I think so.
Yeah.
That's a small cap blend, but if you'll look at it, it goes through periods of time where it really behaves like a growth stock.
Mm-hmm.
And right now they're expanding. They've been beaten up just like everybody
It
else.
had its controversy with the former owner, CEO.
Right. All of that stuff. And so I bought into it, I think in the 70s. And I'm going to hold that one. That's going to be a hold for me. Like I always do, I kind of trade around a core. I was almost hoping it would go down so I could buy some more, but it hadn't yet. It just keeps going
I've been
up.
saying that about Boeing, it too.
Yeah. I honestly am caught flat-footed with not enough Boeing right now, I think. But I'm going to wait. Maybe the Fed will give me a present and I can buy some more of it.
I'm leaning in favor of that present coming to fruition. So with that, folks, thank you again for tuning in to our weekly State of the Market. Forgive my voice. I'm getting over a cold. And we'll be right back here next week. Take care, traders and investors.
See ya.